All right, let's dive in. Today, we're going to pull back the curtain on the world of trading. Forget all the confusing jargon, forget the hype you see online. We are going to build a solid foundation, a real blueprint for understanding what it actually takes to navigate the financial markets. So let's get right to it. So, here's the big question, right? The one you have to ask yourself at the very beginning. Is trading just like spinning a roulette wheel, all luck? Or is it a skill, something that can actually be learned and improved over time? How you answer this is going to define your entire journey, and it's what separates the hopeful amateur from the disciplined professional.
And the difference really is having a plan, a strategy, a blueprint. It's all about shifting the odds from pure chance to calculated probability. So let's build that blueprint together, starting with the very first piece. Okay, before we can even start talking about fancy charts or strategies, we need to get crystal clear on the core idea. What are we actually doing when we say we're trading?
The real key here is the time frame. See, an investor is kind of like someone planting an oak tree. They're hoping it grows over decades. A trader, on the other hand, is more like a market gardener. They're looking to harvest profits from price movements that might happen over days, hours, or, believe it or not, even minutes. It's a much more active, hands-on game. So, where does all this buying and selling actually happen? And what are the invisible forces that make prices shoot up one minute and dive the next? Let's take a look at the global arenas where traders play. First up, you've got the stock market. This is the one most people have heard of. When you trade stocks, you're basically trading tiny little pieces of ownership in public companies. Think Apple or Tesla. You're really betting on how well that company's doing and what the market thinks it's worth. Then you have Forex. That's short for the foreign exchange market. This is where all the world's currencies get traded against each other, like the euro versus the US dollar. And just to give you a little perspective on the scale here, this is the largest financial market on the planet. We're talking trillions of dollars changing hands every single day. And of course, you can't forget the new kid on the block, cryptocurrency. This is the wild 24/7 frontier of digital assets like Bitcoin and Ethereum. It's famous for its extreme volatility, which, you guessed it, means there are huge opportunities, but also some really significant risks. You know, no matter what market you're in, the things that move prices are pretty much universal. At its core, it always comes down to simple supply and demand. But that simple formula gets rocked by news, economic reports, and maybe most powerfully of all, by raw human emotion. That collective feeling of fear and greed can turn a market on a dime. All right, so we know what moves the prices, but how do traders see and interpret all this happening in real time? Well, they use charts. You can think of it like learning to speak a new visual language, the language of the market. And it all starts with two really key concepts. Okay, these two ideas are the absolute bedrock of reading a chart. Support acts like a price floor. It's a level where buyers tend to jump in and stop the price from falling any lower. Resistance, well, that's the ceiling. It's where sellers usually take over and stop the price from going any higher. Finding these levels is a trader's bread and butter because they give you clues about where to get in and out of a trade. So, how do traders take ideas like support and resistance and turn them into an actual strategy? It really comes down to two main ways of thinking, two main schools of thought for analyzing the markets. Think of them as the two primary lenses in a trader's toolkit. So on one hand, you have technical analysis. This is all about the chart itself, the patterns, the trends, the story that the price is telling you. And on the other hand, you have fundamental analysis. These guys kind of ignore the chart and instead focus on the underlying health of the company or the economy to figure out what an asset's true value should be. A lot of traders actually end up using a mix of both. Look, we could talk about analysis and cool strategies all day long, but I'm telling you, none of it matters without this next part. This is, without a doubt, the single most important rule in trading. It's all about mastering your risk. Just let that sink in for a second. You could have the world's best strategy for picking winners, but if you don't manage your risk, you will fail, period. It's not about being right all the time. It's about making sure that when you're wrong, your losses are small. So here it is, the cardinal rule of survival. As a beginner, you should never risk more than 1% to 2% of your total trading account on any single trade. If you have $1,000 to trade with, that means your maximum loss on any one idea is just 10, maybe $20. I'm serious. This rule, all by itself, is what will keep you in the game long enough to actually learn. And these are the non-negotiables. A stop loss is just an automatic order that gets you out when a trade goes bad. It's your safety net, and you have to use it. You plan everything, where you'll get in, where you'll take profits, and your maximal loss before you ever click the buy button. And then comes the hard part. You stick to the plan, especially when your emotions are screaming at you to do something else.
Okay, so you have the core concepts, you have the tools, and you have the most important rule of all. How do you actually start putting this all into practice safely? Let's map out the path forward.
This is the path the pros take. There are no shortcuts. You start with education, books, courses, whatever it takes to build your knowledge. Then you move on to paper trading. That's using fake money in a real market simulator. This is where you get to make all your mistakes for free. Only after you can prove you can be profitable there do you even think about starting with a very, very small amount of real money.
And listen, it is so important to have realistic expectations. This is not a get-rich-quick scheme. It's not a race. Becoming a consistently profitable trader is a skill, and like any serious skill, it takes a ton of time, practice, and patience to develop. Think of it more like learning to be a surgeon, not buying a lottery ticket.
And this, right here, this really sums up the entire blueprint. Successful trading isn't about being a genius. It's about consistent discipline. It's about having a prepared plan and then having the strength to execute it without letting fear or greed call the shots. So, we're back to where we started. You now have the foundational blueprint, the very thing that separates the professionals from the gamblers. The only question left is, what are you going to do with it? Are you going to trade with a plan, or are you going to trade with hope? Because in the market, hope is not a strategy. The choice is yours.